folks. So many banks are failing and more will fail as the Feds increase interest rates to curb inflation. And if I were you, I would be very concerned. You see, having spent 3 years of my life as a management consulting at a very senior level at FDIC, I know how these mergers and acquisitions happen and how these bank failures are predicted before they happen. Furthermore, I've spoken to 2 senior executives from FDIC, former executives whose names shall remain undisclosed. And I got the story behind the scenes of what really happened versus what the media is telling you. So this is a very important topic and it directly affects you and your families. So I was at the local bank recently and I banked with 4 different banks: Wells Fargo, Capital One, Chase, and Apple Credit Union. I have 8 bank accounts with these banks. But what I noticed recently is that the banks are closing their branches. Capital One, especially in the Fairfax, Virginia area, have closed most, if not all, the branches. So the times are changing, folks, and there's a reason for that. And oh, by the way, if you like the channel, please like and subscribe. Show some love to your boy AK. Thank you. As I mentioned before, having spent 3 years at FDIC at the highest level, I know exactly what transpired in this debacle of First Republic Bank and Silicon Valley Bank, and why JP Morgan and other larger banks consume these other banks and buy their assets. We'll unpack this and more, and we'll come to a conclusion in the end. So stick around till the end so you can protect yourself and your families and your financial assets that you've worked so hard for, and you can't trust these banks. While the media is telling you that interest rates and interest hikes have caused all this debacle, inflation, and so on and so forth, which is partially true, but it's not the entire picture, folks. If you've heard of something called Dodd-Frank Act, which was enacted in 2007, 2008, because of the debacle, the financial crisis we face, folks, Dodd-Frank was put in place to avoid these type of failures from happening. Unfortunately, these failures are still happening. What does that mean? That means that somebody's not paying attention. Somebody took a lot of loans and spread them across at low interest rates. And when the arm went up, they came crashing down. FDIC has a department for research and analysis and compliance. They follow these trends of the banks. They monitor all these banks and more, all the smaller banks. They predict through complex statistical model of what's going to happen to each bank, of which bank will survive in the next 1 or 2 years and which bank will die. Why? Because they insure every single account. $250,000 is the max that FDIC can insure per account, per individual, per bank. So based on these statistical models, FDIC then goes and talks and consults with other banks which are much larger and doing financially well, such as JP Morgan, whether or not they want to buy and consume the liabilities and assets of the smaller banks or the banks that are about to fail. And that is not what happened with First Republic Bank. First Republic Bank lost a lot of loans and investments because, again, they were at a low interest rate got higher, these loans were not giving them the return they expected. The lenders and the people, the investors, stakeholders started taking money out. Over $10 billion were taken out of First Republic Bank, folks, in a matter of weeks. Think about that for a second. Point to be noted, folks, that average stakeholder in this bank owned an account of over $1 million. Now, going back to my point that I was telling you, right? FDIC insures how much? $250,000. So the remaining amount of this $1 million is not insured, right? These folks knew that FDIC will not insure if this bank goes belly up, because the regulators were going to close down this First Republic Bank. Somebody tipped off one of these stakeholders and they told everybody, because they always travel in a pack. However, FDIC still ended up paying $13 billion to cover the remaining assets that JP Morgan is now going to acquire. Okay, you see my point? FDIC pays the stakeholders, pays JP Morgan Chase, and the bank gets closed by the regulators. Now, when the California regulators closed the bank, Joe Biden calls Jamie Dimon of JP Morgan, asked him to make this problem go away. You remember the famous line from Trump, right? Can you do me a favor though? And Jamie Dimon did exactly that. He said, okay, we're going to assume the liabilities and assets of these banks under certain conditions if you can make FDIC pay some of our bills. And FDIC was directed by the president to take some actions that they ended up taking. So now, why did this happen? And why is this bank so significant, folks? This bank is a very significant bank because the people who have assets in this bank are some very powerful people. And just to name a few, one of them is Apurva Mehta, who's worth $1 billion. Okay, this guy started Instacart, if you know the famous Instacart. The second stakeholder is Stephen Ross, $11 billion real estate mogul. Talk about a guy who has success, right? Also, Champat Pelatalpia, the former Facebook executive, I can't spell his name, I'm sorry, but $500 million of assets in this bank. So you can see when these people who are so powerful, when they scream, the White House has to listen because they also fund their campaigns. These are all connected dots, folks. I hope it makes sense to you. How FDIC, Jamie Dimon, Joe Biden, Stephen Ross, and all these guys are all connected part of the big puzzle. They're all trying to help their own wealthy friends, if I may say so. The issue I have is that $13 billion that FDIC paid, guess what, where it came from? It came from you, it came from me. It's taxpayer money. Why? Why would you do that? Now you also must ask, AK, tell me about these banks and their so-called wealth managers. Were they sleeping on the wheel? Well, the answer is yes. There are three reasons for that. Number one, complacency. Number two, poor planning. Number three, grandiosity. Now, grandiosity is a funny thing, folks, because it makes you think that if you can do it once, you can do it twice and three times. Because these people who were supposedly the fox guarding the hen house are the ones who basically sank the ship. And they had to have known, folks. How could they not? What happens at these big companies, folks, they all get in a room, in a meeting, okay? All these big executives. And they all tell each other what's happening. But they also tell you that you better not tell anybody else this is happening, or else you will be fired. You'll be out of this board. So they have this pact among them. They don't even go and tell their family members what's happening. Banks fail every single year, folks. This is not a big deal. But these banks, these type of banks, they don't fail that often. So there's something really fishy that went on there, and we will discover those details maybe in a separate video, because I'm still getting information from the executives I know from my previous connections. So what now? What do we do with all this information, folks? I have something to say about that. And what I have to say to you is that if I were you, I would definitely spread my money across multiple accounts. I hope that Federal Reserve can see the signs and the writing on the wall, at least slow down the rise of interest rate. This is a warning sign. This is a telltale sign. Federal Reserve needs to really understand the issues they have created by dropping the interest rate so low for so long to save the economy. Now they're sinking the economy again through inflation and hurting the average Joe. For you guys, I think the best advice I have is that spread your money in different accounts, okay? As much as possible, as low as possible. As I mentioned in the beginning of the video, that I have 8 accounts in 4 different banks. Call me crazy, but this is the reason why I've done that, folks. The great investor, Ray Dalio, who always says cash is trash. This is an example of why cash is trash, folks, because you put it in the bank, they print more money, your cash is valued less. And oh, by the way, the bank where you think your money is safe and is insured by FDIC does not fully insure it. But even more important than that, I would try to buy assets, not liabilities. Try to buy some assets like I put my money in real estate. Real estate is an excellent asset class, commercial or residential. Invest wisely. Gather assets that can give you some leverage over what's happening in the market. That's how investors thrive. Now, as I always mention, I will mention a book that you guys might like. This book is very, very good. This book is called Amp It Up, and it's by Frank Slootman. He's a former executive at Salesforce and many other companies. He took them to public, made billions of dollars for them. Very smart guy. This book is about amping up your velocity. And if you know what I mean, you may produce 8 hours worth of work. The question is, in those 8 hours, how can you do 10 hours of work, and so on and so forth. So what this guy does, Frank, is he goes to companies and he finds ways to amp up their velocity and create momentum that these companies that he takes to public become very efficient executing their ideas. Well, I hope you guys enjoyed this video. If you did, please press a like and subscribe. For those of you who don't know who I am, I want to introduce myself. I am an investor, entrepreneur. I own some e-commerce stores. I have some properties. I built affordable housing for people who need them, people who don't have quality affordable housing. That's really what I do. That's the gist of my passion. And if you have any questions that I can answer, feel free to drop a comment. I'd be happy to get back to you. So with that, thank you all. I will see you in my next video. Bye now.